Welcome to the Capital News. I am your host, Alex Karitis. Today is May 20th, 2019. Thank you so much for joining me. Hope everyone enjoyed their weekend. So there's a lot to get to today. A lot of news, a lot of headlines, a lot of elections either taking place over the weekend or set to take place this week. Markets, I believe, are in a state of flux. We have some escalation in the U.S.-China trade war. We have some escalation in the tensions between Iran, the United States, Saudi Arabia. So there's a lot to get to. So the S&P was down 19 points. The Dow closed down 84. The NASDAQ closed down 114 points, representing a 1.5% decline. The Russell 2000, the small cap index, lost 11 points to close the day. Oil, if you're looking at WTI and Brent, you're at 63 and 73 respectively. Give 10 cents here or there. Nevertheless, not moved too much. Now, that's something we have to pay attention to because not only is the price of oil a function of supply and demand, but you also have to look at the strength and or the weakness of the U.S. dollar. You also have to look at geopolitical risks. Well, right now we have some geopolitical risks in the Middle East. We have those waivers being removed from those countries who were, quote-unquote, allowed by the United States to trade with the Iranians, particularly buying their oil or natural gas. Now that's done with. So we got some tensions brewing there. We had the Iranians, allegedly, if you're listening to the Saudi Arabians, that they were responsible, the Iranians were responsible for sabotaging those oil tankers in the Persian Gulf last week. You have the president taking to Twitter, basically threatening Iran not to threaten us again, for if they do, it will be the end of Iran. So that's not a pretty picture. It might be well for the military-industrial complex, but it will not bode well for the men and women who have to fight that war. God forbid we engage in another one. We also have the meddling that is still taking place in Venezuela. We still have a breakdown in Libya. So these are all oil-rich, natural gas-rich countries. Tensions are brewing. So we still have oil up there because of those reasons. I honestly think, absent these geopolitical tensions, I think oil would have been rolling over, and I think we would have been lower. I've been consistent with that. Are there things that obviously can prop it up? Yes, that's one of them. Geopolitical tensions most definitely are events that can keep the price of oil elevated. Because we were, high 30s, low 40s last year, and everybody was getting a break at the pump. Now that's reversed. Now we're in the midst of the spring-summer driving season, so we always anticipate higher gasoline prices, which is not going to bode well for the consumer. So we'll see what happens. We'll see what our tweeter-in-chief says if he's going to start coming after OPEC once again. Haven't heard much about him attacking OPEC recently, but as far as we know, OPEC and Russia both are expected to continue with their production cuts. So that will put upward pressure on the price of oil as well. Gold is at $1,276 an ounce. Silver still remains below $15 an ounce and is trading at $14.41 an ounce. So for those of you out there who like to stack the precious metals, particularly silver, buy low, sell high. That's all I can tell you. 10-year U.S. Treasury was up about 1 percentage point for the yield, and now we have 2.416% on the 10-year U.S. Treasury. So still right there on that 2.4 handle. The VIX, the volatility index, inched up 2 percentage points for the day, closing at $16.31. Now, as we make our way through some of the headlines that's going on right now, I know we were discussing last week the Australian dollar and how it was hitting multi-year lows, and this is on the back of expectations in the marketplace that the Reserve Bank of Australia is likely to cut interest rates at some point this year. They are basing a lot of their decision on the job market. Well, from recent headlines last week, it printed a higher unemployment figure. So again, that led more traders to believe that the Reserve Bank of Australia is going to follow through on their word, making unemployment sort of the key benchmark at which they are going to make their decision. And so markets now are pretty much pricing in some sort of a rate cut later this year. In the midst of all of this, we are not surprised because the Australian economy has been front and center on this podcast and has been for quite a while. It was on our list of 30 market risks for 2019 that was put forth by Deutsche Bank. And of course, we've discussed that in detail on multiple podcasts throughout this year. We've also added to that list. So we have the Australian economy, which is pretty much was able to skate or skirt from a recession basically for the past 30 years because of the growth in China and the growth in Asia. Now we're starting to see that start to reverse. So no surprise, we're starting to see the Australian economy slow down as well. We're also seeing a depreciation and deceleration in home prices. So in some areas, they are not rising as fast as they were, and in some areas, they are declining. Okay? So this is something that we have been discussing. This is no surprise to us. The central bank in Australia, the Reserve Bank of Australia, is aware of this. They do not want the country to go into recession, obviously, but, you just have to let the forces of economics take hold. Now, of course, central banks don't like that. They like to be in control. Federal governments like to be in control. That's what we're against here at the Capital News, but nevertheless, this is the world in which we live. So the Reserve Bank of Australia will do what they can to assist the economy from not going into recession, or at least mitigate the effects thereof. Of course, it does not mitigate the effects thereof. It just puts a Band-Aid on a bullet wound, if you will. It just makes it look better, but you still got an underlying issue. And the best way for that to be cleared is for it to clear itself of a natural process. Allow for the deleveraging, allow for debts to be written off, allow for people to go to court, do what they got to do, go into bankruptcy, have your fire sales, people to unfortunately go through the foreclosure process. That's how it works. I know everybody wants to be happy and everything's fine, but unfortunately, that's not the world in which we live, and you have to allow free market capitalism to work and do its thing. Believe me, it might hurt ripping the Band-Aid off. Do it quick, and you can start to recover that much faster. Now, the other interesting thing that took place regarding our friends down under is there were elections that were held. The Prime Minister, the current Prime Minister, was expected to lose. He won. So that was a surprise to the markets. You saw a little bit of a relief rally in the Australian dollar to the upside against the U.S. dollar. You also saw the Australian stock market make all-time highs. This is because the person who was supposed to win, who everybody thought was going to win the prime ministership of Australia, was calling on increased taxes, regulations on the banking industry, closing of loopholes, a whole host of things. And of course, banks don't like being handcuffed. I mean, God forbid you do anything with the banks. I am not a proponent of increased taxes, but nobody knows how to solve these problems, apparently. You're just supposed to tax and spend and regulate. Not the solution. But nevertheless, that person was expected to win. He did not. So the prime minister retains power. The markets liked it. The Aussie dollar had a little bit of a relief rally. I think all of this is going to be short-lived because this does not change the fundamental picture of what is taking place globally. It does not change fundamentally what is taking place in Australia. All that would have done was maybe cause things to go down quickly. That's all it would have done. Now it's just a little, we kicked it down the road a little bit because regulations aren't coming up, taxes aren't going up. Okay, we'll see what happens, but I do not think it will be a pretty picture for our friends down under. I just don't. Economic gravity is taking hold. They're going to go down with it. Now, we also, again, have the European parliamentary elections taking place on May 23rd. This is still in the midst of all of the chaos surrounding Brexit in the UK. So over the course of last week, we were talking about how the British pound has been declining. That remains the case. There is uncertainty surrounding the European parliamentary elections. There is still uncertainty regarding Brexit. So this is no surprise to us here. Once there is some sort of certainty, we can expect some sort of relief rally. We'll have to dive into the facts of the case to see if it'll be something that will be prolonged or if it was just a relief rally and it's going back down. Time will tell. But what we are anticipating and what we discussed on episode 72A during the geopolitical podcast, during the EU elections, we are anticipating here that there will be a whole host of members who will be elected to the European Parliament who will be populous, spanning the entirety of the European Union. They will be coming from Greece, they will be coming from Italy, they will be coming from France and Spain, and they will most definitely be coming from the UK because they're still a part of it. So now you have the likes of Nigel Farage, a huge advocate for Brexit, now starting once again his own party, the Brexit Party. So you're going to have very similar-minded people who are likely to be elected, and now you're going to have a whole host of people like Nigel Farage, not only from the UK, but from the entire European Union, who are going to get elected, in my opinion, and they're going to cause chaos. They are going to cause chaos because people do not like the rules and what is taking place in their respective countries. They just don't like it. And we're going to talk about that because the markets in Europe did not perform too well today. So we're going to go around the horn. We're going to go and look at we already discussed the U.S. markets. We're going to discuss the Asian markets. We're going to discuss the European markets because everything is interconnected. And again, going back to our list of market risks for 2019, we have to pay attention to all of them because we don't know what is going to set all of this off. We know we have a whole bunch of dominoes that are set up, ready to go down. What's going to be that first one is anybody's guess. It might even be something where nobody is even looking, and that's probably where it's coming from, because that's usually what happens. The other thing we're going to look at, too, if we have time, is we're going to look at some of the global commodities. We're going to see, well, you know what? How have they been performing? Is that indicative of where we were, where we are, or maybe even is it a leading indicator as to where we are going? So we're going to have that discussion. Some of the negative news today, because the U.S. markets were never in the green. It was a red day all day. Now, there was, some gyration, some volatility. We're accustomed to this. Whether it's a statement, whether it's a tweet, whether it's hope, makes no difference. We are used to these spikes, this type of volatility. But nevertheless, there was another sell-off at the end of the day. So again, something to pay attention to because for the first several months of this year, we were seeing a bid at the end of the day for an increase in buying. Now we're starting to see the sell-off. Will this continue? Something to monitor, something to pay attention to. But we had the Chicago Fed National Activity Index out today, and that fell. So here we have the Chicago Fed National Activity Index dropped to negative 0.45% in April, below market expectations of a negative 0.33. All right? The contribution from production-related indicators to the index declined the most. Interesting. Production. I thought this was the greatest economy ever. All of these production manufacturing jobs were coming back all over the place. Doesn't appear so. So again, the contribution from production-related indicators to the index declined the most, followed by the personal consumption and housing category and the sales, orders, and inventories component. Not a pretty picture for what's going on right now. And this is basically a leading indicator as to what's likely to transpire in the economy over the coming months. This is a trend because that's what you look at. You don't just look at these one-off month-to-months. You look at the trend. And when you look at the data, the trend is to the downside. And when you're talking about production-related, that ain't painting a pretty picture, is it? Especially for the narrative that the president is trying to weave, that this is the greatest economy ever, that all these manufacturing jobs are coming back, and everything is just rosy and peachy. It's just not the case, folks. I'm not here to lie to you. Enough's enough. We need leadership. That's why I wrote a letter to the president. That's why it was a podcast that I read that letter to you guys last week. Check it out if you haven't. Please, respond. Print it yourself. Send it out yourself. Change it. Do what you got to do. Get it out there. I'm telling you, there is no leadership. We cannot have these types of exaggerations and flat-out lies when it comes to this economy, when it comes to this trade war. You just can't do it. I mean, we know this. When you're in war, the first casualty is always the truth. But, I mean, this has been the case with this president, unfortunately, for quite a while. And I am sick and tired of it. You know, I defend him on a whole host of issues. This is not an anti-Trump podcast. Not even close. This is the truth podcast as I see it. This is my opinion. This is my analysis. It's my show. I don't care who you are. You're not above the law. If you're lying, I'm calling you out on it. If you're exaggerating, being hyperbolic, I'm going to call you out on it. Same thing with me. If you think I'm exaggerating, being hyperbolic, please send a message. I'm happy to listen. I'm open-minded, and we'll have a debate on it. Please do it. So that's the Chicago Fed national activity. Again, another piece of the economic puzzle that is not painting a pretty picture. President doesn't want to come out and tell you the truth? Okay, just read the headlines, just read the tweets, and go back to sleep. Nothing to worry about. Now, we've had another escalation in the U.S.-China trade war, which is, I think, also drove the stock market down today. And we're talking about Huawei, the Chinese tech company, telecom company. This is something that we were discussing last week as well. So this is no surprise that this was a carryover through the weekend and today, because the United States is pretty much banning entirely U.S. businesses from doing business with Huawei and from Huawei doing business in the United States. Now, Huawei is a market leader in 5G, which I'm sure many of you have heard. That's the 5th generation technology out there. It's an increase in speed, an increase in bandwidth for your internet and telecommunication services. And perhaps, maybe the United States is behind in this, and we're saying, no, China, you're not doing it. You're not going to outcompete us and outbeat us on this, so we're going to stop this. Now the question is, will the Chinese retaliate? And if they do, how will they do it? Well, we had a big sell-off in the NASDAQ today, losing 1.5 percentage points. A lot of that was driven by technology companies, no surprise being in the NASDAQ, semiconductors, and Apple, because Apple is huge. I mean, if we want to attack Huawei, maybe the Chinese will attack Apple. And boy, wouldn't that get nasty. But it's going to be interesting to see, because we already know from discussions last week that the president seems to be happy, no rush. At least that was according to some of his tweets last week. And we know that the Chinese, from their comments that we read from their papers, they're saying, you know what? We're in no rush either. You know, we're not going to kneel. We're not going to bend the knee to President Trump in the United States of America. Get patriotic. Become nationalists. This is what the Chinese are saying to their people. Don't worry about it. We will be just fine. We will see what happens. But this is what happens when you get into these types of escalations. But that was a big one. The Huawei deal was a big one. I'm not surprised the United States took the stance that it did. I'm also not going to be surprised if the Chinese retaliate in kind. Then it'll get interesting to see if we retaliate again and if they retaliate, because it's only about a month away where you're going to have the G20 in Japan. Will the president of the United States meet with the president of China? That's going to be an interesting question. We will see what happens. Some other headlines as we make our way through here. We have Dress Barn, the retailer. They are filing bankruptcy. They're going out of business. So they are going to close about 650 of their stores. That's Dress Barn, filing bankruptcy, going out of business. They will be closing 650 stores or thereabout. On the retail side of things, we already know to date that there are going to be about 6,000 store closures. 6,000 store closures. That is already more than the entirety of 2018. And we're not even through May yet. So much for a strong and resilient consumer, Mr. President, and so many of the other bankers that were reporting their Q1 results saying, well, the consumer's strong. No, they are not. They are maxed out on credit cards. Now, to a banker, that is a strong consumer because they're charging 15, 20, 25, 30 sold, 30% interest rates. So you being tapped out on your credit cards is fantastic news for a banker. So anytime you hear a banker talking, assume that they're lying. And you'll probably be right. Ford Motor Company is to cut 7,000 jobs. Now that's globally, but nevertheless, it's 7,000 jobs. I believe about 20% of that is here in the United States. These are white-collar management jobs. Now, of course, the story from Ford is, well, we want to streamline. We're doing a restructuring. There's too much hierarchy. We want to streamline everything, quicker decisions, better products, yada, yada, yada. And, of course, we want to cut costs. That's it, folks. That was it. They saved it for last, but that's the one you got to pay attention to the most. We got to cut costs. That's what I've been telling you. Now, the interesting thing is, will the president interject here? Will he get involved? We get on Twitter. We make some interviews. What's he going to do? Because these are white-collar jobs. These aren't factory jobs. These aren't the blue-collar jobs. So it'll be interesting to see how the president plays this one. But it ain't pretty, folks. 7,000 jobs, Ford Motor Company, gone. Leaving. Not pretty. This has to do with a lot of debt. I'm telling you, this is what it is. This was on our list. It remains on our list. It remains top of our list. Not only does it remain on our list, it's also something that even the Federal Reserve can no longer ignore and has been talking about if you read some of their documents from last year and continuing to this day. Because I'm not going to get into it tonight, but you had Fed Chairman Jerome Powell give a speech this evening, and again, he's talking about corporate debt. Now, of course, there's nothing to see here. It's worrisome, but it's not elevated for concern. It's something we're monitoring. It could be a concern, but right now it's just fine. That's kind of the same language that Ben Bernanke was using in regards to the housing market in 2006. And what happened shortly thereafter? Oh, yeah, that's right. The financial crisis, one of the worst in history. Nothing to see here. Everything's fine until it ain't. I'm not going to be surprised if that's the same case with the U.S. corporate debt market. Really, the global corporate debt market is a whole host of other debt markets too. Consumer, state governments, federal governments, everywhere and everything. No place to run, no place to hide. Who's going to bail out the governments? I mean, that's the biggest question of them all. I mean, at least 08, 09, I was totally against the bailouts. But Uncle Sam still had some money. He had about half the debt he does today. So you can say, okay, well, maybe we can bail him out. Maybe it is for the good, yada, yada, yada. Of course it wasn't, but you can make the argument. Okay. Now, if all these corporations go under and Uncle Sam has twice the amount of debt he did a decade ago, there's no way Uncle Sam can bail out all these corporations. There's no way they're going to be able to bail out the everyman. So who's going to bail out the government? Well, that's a good question, isn't it? It's going to be interesting to see what happens. I don't want this to happen, but it's going to. It's just a question of when. Now, we make our way around the world. Let me pull up some stocks here. Obviously, we went through the horn when we were talking about the U.S., but if we're talking about Europe, we had the FTSE, of course, that's the UK market. They were down 0.5 percentage point. The DAX, the Germans, lost over 1.5% today. The CAC, that's the French markets, again, they also lost 1.5 percentage points. The Italian markets, look out for this one, they declined 2.7 percentage points today. 2.7%. That's huge, folks. This is because I have to think of the economy still being in shambles. They are in recession. Nothing has fundamentally changed. And you have the EU parliamentary elections taking place. And they still have no plan whatsoever to handle their budget, at least not within the EU rules. This goes directly to our argument of the rise in populism. They're giving the finger to the EU bureaucrats. I'm fine with that. I got no problem with that, but I'm just telling you what's happening. Sometimes to fix the ship, you got to go down a little bit. It's got to get a little dirty. That's what's taking place right now. It's getting a little bumpy. But I think on the other side, everybody can come out ahead if the right policies are enacted, if the right people are there to tell the truth and to actually lead. Again, I know I'm being optimistic, but it can happen. We have the Spanish markets. We're down about 0.9%, so not good with the European markets ahead of an election only a few days away. So we're going to have to keep you posted on this because everything, again, is interconnected. Now, we had some news over the weekend in regards to the Japanese economy. There was a surprise increase to GDP. So on today's trading, you had the Nikkei a little, they rallied a little bit. Nothing to write home about for any means, but they did rally. But that, I think, is short-lived. And I'm very skeptical. I mean, it was not a stellar GDP report. It was just unexpected to the upside. And I'm skeptical of it, just like I was skeptical and remain skeptical of United States first quarter GDP. Because when you look at all of the other data, I mean, Japan is an export powerhouse. Now, their exports, obviously fizzled because we've been discussing that for quite some time, but their imports dropped. So if you have the imports dropping at a faster rate than what the exports are, just the way in which the calculation for GDP is, you can have a higher GDP rate. And I think, now I didn't do a deep dive into it, but I think that that's probably the driving factor. So it's not a pretty picture. It's not because there was actual greater growth. It was just the arithmetic calculation. of how GDP is calculated. So there's a lot of funny business going on. I am highly skeptical of all this crap. It's not even funny. But as we look right now, again, we do these podcasts later in the evening. The Nikkei is only up 2 points right now, so they're cooling off. The other Asian markets, when you're talking about the Shanghai, they were down in today's trading, but right now they are rebounding nicely, and they are up 1.5 percentage points for the day. The South Korean market is also up about 0.9% as we're doing this podcast. And the Hang Seng, the Hong Kong markets, are up 41 points, just representing 0.1%. Now, again, the Australian markets made all-time highs, as did the New Zealand markets. I believe that's probably on the political elections down there. And also with New Zealand cutting interest rates, I'm sure that's starting to have some sort of effect on their marketplace as well. So we went all around the horn. I don't have enough time right now to get into the commodity markets, but don't worry, those aren't going away. We're going to have a discussion, though, with the price of lumber, with the price of copper, and with the price of aluminum. That's what I'm going to focus on tomorrow, unless there is some sort of earth-shattering news. But those are the commodities I want to have a deeper discussion on, because are they forward-looking? Because they are building materials. And if you're building, you're growing. But if you're not building, you're stalling, you're slowing down, and these are things that we have to pay attention to. We're not just going to look at them as one-off. We're going to look at them against the backdrop of how the markets have performed when they were at the prices that they currently are. So stay tuned for that. We're going to talk about that in tomorrow's podcast. So thank you guys so much for joining me. I know it was a lot discussed today, but there's a lot of news going on. It doesn't matter if it's political, geopolitical, economic. It's all interconnected. We have to pay attention to it all, and we have to, again, have a plan in place, be diversified, build cash, be prepared. Thank you so much for joining me. Please like, share, subscribe, get the word out, leave your comments. We do love hearing from you. This is the Capital News. I am Alex Karitis. Godspeed.